I have a 3-step formula that I've backtested hundreds of times, and every single month I tested it, it was profitable in the long term. No indicators, no patterns, just pure price action. And by the end of this video, you too will know this strategy and will be able to take calculated trades just like this one and make reasonable amounts of money. But before we jump in, this video is sponsored by Trade Investments. If you're looking to trade US stocks, options and futures, contact Trade Investments for training. Their contact details are in the description, and I also did a full interview with them that you should definitely check out. They are the real deal when it comes to US markets. Follow and connect with them. The link is in my description. Now, let's get right into it. Step 1 involves market structure. Now, this is arguably the most important part because even if you slightly mess this up, it can ruin the whole strategy. One of the first things you learn as a trader is uptrends and downtrends. A chart that makes higher highs and higher lows, that's an uptrend. A chart that makes lower lows and lower highs, that's a downtrend. Sounds simple, right? You're probably thinking, I already know this. Well, what if I told you you're probably doing it completely wrong? Let me explain. So picture this. The chart makes higher highs and higher lows, and yes, we are in an uptrend, but then price starts heading down right away, and it makes a new low and breaks through a recent point. Now, here's where most traders go wrong. They think since we broke the low, we are now in a reversal, let's go short. But that low is not valid. Why? Because price never really broke the previous high before forming that low. And in this strategy, a low is only valid if it broke the previous high. If it didn't break the high, it's not a real low and the trend hasn't changed. Let me explain. A low is only validated if it broke the previous high. Once price breaks the high, then the low becomes the official. Then we know we are in an uptrend, and until that happens, we can say that the trend has not changed. Here's a trick. If price pulls back and doesn't break the real low, we are still bullish. If price breaks the real low, then we shift to bearish. And as we go up and break new highs, we shift our valid low forward. It might feel like a little bit confusing at first, but if you remember just this one thing from this part, a low is only valid if it breaks the previous high. That rule alone will keep you aligned with the trend. Now that we understand market structure, step 2 is identifying supply and demand zones. It's simple. In an uptrend, we look for demand zones. In a downtrend, we look for supply zones. You want to buy from demand and sell from supply. Here's why. When price makes a big move upwards from a certain zone, that tells us buyers were aggressive at that level. So if price returns to that area, buyers will likely step in again. Same thing with supply. If price dumped hard from a zone, that means sellers dominated. When price comes back, sellers may reappear. Here's how to mark a demand zone. Look for a small consolidation before a big move upward. Mark the candle just before the impulse. Use your rectangle tool to highlight from the low to the high of that candle. That's your demand zone. Then, now wait for price to come back to that zone. Enter your trade. Stop loss goes beyond the zone. Take profit goes at the recent high. It's that simple. Let's look at a real chart. We see price moving up, pulling back, then breaking a previous high. That confirms we are in an uptrend. We mark the valid low. We only look for long trades, no selling. We find our demand zone from the consolidation before the impulse move. Price returns, we enter. Boom, another winning trade. Here's another example. This time, price breaks the valid low. Now we are in a downtrend. So now we only look for supply zones and only short trades. Same steps. Mark the consolidation before the drop. Wait for the price to return to that zone. Enter your short, stop loss above the zone, take profit at the recent lows. Now we have another winning trade. Another supply zone forms, same routine. Entry, stop loss, take profit, another win. It just keeps working. Why? Because we are trading with the trend, and that increases your win rate massively. Step 3 is all about risk to reward. Sometimes, even when everything checks out, the risk to reward on the trade just isn't worth it. Let's say you are risking $100, but your profit target is only $120. That's a bad trade. In this strategy, we only take trades with a minimum 2.5 to 1 risk to reward ratio. So that means for every $100 risk, you want at least $250 return. If a trade gives you anything under 2.5, you don't take it, even if the setup is perfect. The rule alone will filter out bad trades and make your results way more consistent. Let's look at this final example. Price is in an uptrend. We find a demand zone, clean consolidation before a strong move up, price returns. We enter, stop loss below the zone, take profit at recent highs. We check the risk to reward. If it's 3:1, we are good. Let price play and we have another solid winning trade. That's it. A complete strategy with these 3 steps. 1. Identifying market structure. 2. Mark supply and demand zones. 3. Only take trades with over 2.5:1 risk to reward. Stick to those 3 rules and just repeat the process. If you found this video helpful, feel free to join our free signals group on WhatsApp, and you can reach out to us as well for Forex trading classes. Check our recommended broker, that is Windsor Brokers, in the link in the description, and I'll see you guys in the next video.